And that was really an impressive montage of what's been happening here in October. It has been a tricky month for investors, even as stocks do rally for a second day in a row. But let's take a look at the wreckage and what might be next. If we look at the various markets for the month of October, take a look at the S&P 500 futures down more than spot, which the S&P 500 futures on pace for the worst month since September of 2011. That, of course, when the U.S.'s credit rating was downgraded. The NASDAQ futures down 8.3%, the worst month since November of 2008, of course, after Lehman collapsed, the beginning of the financial crisis. That's the degree of the selling power that we're seeing right now. And crude getting in on that action, too, in an official correction just in the month of October. A piece of that, of course, could be the Bloomberg Dollar Index. Take a look at that, up 2.4% on pace for its best month since November of 2016, when the presidential election occurred. That, of course, all of this points to money flows, money flowing out of the riskier growth assets into the haven dollar. Very much a risk-off picture. The big question, though, of course, is what's next? Now, if we hop into the Bloomberg, a long-term chart that really stands out to me, perhaps one of the most powerful charts out there, is of the dollar yen. So the United States dollar against the yen, both havens, but the yen is considered to be a greater haven than the dollar. This is a multi-decade chart, and we see the tremendous downtrend. So that yen beating the dollar over the last several decades. But more recently, we've had the dollar overpowering the yen, but we see the downtrend in play, suggesting we might just go back down into the range. That would tell you that the haven yen could outpower the U.S. dollar, which in turn could suggest that we could see some real risk off ahead. To discuss more about what could be next, Steve Englander of Standard Chartered, thank you so much for joining us. And I can't think of a more perfect guest, because you, of course, are the head of G10 FX research for Standard Chartered, and that is the root currency, or the root asset class, I should say. Really, everything starts with the currencies. So what do you think is next if we go cross asset class?
Well, we like to think FX is the center of the world. Mm-hmm. If you take a look at the yen chart, I think what it's telling you is that correctly that the yen is undervalued. The only question is when it's going to begin to assert itself, and we think it could happen. It probably requires that the dollar weaken, but we expect that to happen also in the course of the next year. I think October was a month in which you had the panic attack in the market. What was really interesting is that despite the losses that you had in the equity market, what you saw was that the bond market never really bought it. Mm-hmm. And bond yields were very slow to go down and very quick to go back up again. It looks like the panic in the equities, and perhaps due to some of the uncertainty about earnings, is beginning to recede. We don't think the economy is going to be weak. We think it will slow gradually after fiscal. We think the dollar will come down, but we think the path of rates is essentially up. So we don't think that this will last, even though obviously we've had these episodes every couple of months for years now.
So it sounds like you think that the shape of the yield curve is going to change a little bit, perhaps around the election. And one way that you're talking about expressing it is a trade through the euro-dollar contracts, those future contracts. Can you talk to us about this? And here's a long-term chart supporting your view.
Yeah, of course. This is a relative value trade. What we're talking about here is the idea that rates at the middle of the curve are too high relative to rates at the shorter end of the curve and relative to rates further out the curve. And we think that that's going to normalize over time. And as you can see, right now we're at a very stretched level relative to history, so we do expect it to bounce back. What could do it? Perhaps if there's a big rates move in the aftermath of the election. And it doesn't matter whether it's the Democrats who win a little bit more than expected, or even if the Republicans manage to pull it out, we think that will do well in the context of this trade.
So you basically are looking to buy the belly, so to speak, and sell the wings.
Exactly. That's what we're doing.
Thank you so much, Steve Englander of Standard Chartered. Thank you for joining Charting Futures.